Good morning, good evening, good whatever time it is you're listening to this. I hope you're having a good one. I'm going to be going over the datasets, earnings, and the SPY for the week of June 16th, 2025. And with that said, let's go ahead and jump straight into the datasets. Sorry, my screen swapped on me. Okay, so Monday, tomorrow, we have the OPEC monthly report. Now, this isn't super important, but I know many are starting to get interested in trading oil now that the oil prices are kind of in a major uptrend. So, um, I'm not going to go over how to read the OPEC report or anything right now, but just keep in mind how to trade oil is essentially if oil surplus is going to increase, so if we're going to be having new wells, if we're going to be seeing the United States buying more oil, if we're seeing, larger imports of oil, then oil prices will go down. And when oil prices go down, generally the equities tied to those oil prices will also go down. So Exxon, Chevron, Oxy, you name it. There's tons of them to trade, but if surplus is going to increase, then the oil price will decrease. And inversely, if there's going to be things that could potentially hinder the importation or exportation of oil, if there's anything that could potentially prevent, the purchases of oil, so any embargoes, tariffs, wars, you name it. If we start seeing oil decrease in surplus, then we are going to see the price increase in oil, which means that the equities tied to that should be increasing as well. So that's kind of how you trade oil. Just keep that in mind. I'm not too concerned with the OPEC reports right now. I have so much to do everywhere else. I'm not too concerned, but that's at 7 a.m. Now at 8:30 a.m., we have the New York Empire State Manufacturing Index. I'm not too worried about that, but seeing how that's pretty much the only data set tomorrow besides the 20-year bond auction later in the day, the market can definitely use that as a hawkish or dovish data set. Now, sorry, I'm losing my breath because my daughter was having a tantrum. Uh, anyway, how to read if this is going to be a hawkish or dovish I can't talk. Dovish data set. Um, so the previous was a negative 9.2, and this one is expecting to come in at negative 5.9. So it's still a negative data set, meaning it's dovish. And when things are dovish, generally it is bearish for yields, meaning bear or yields will go down. Usually the dollar decreases and equities increase in price. Um, if it's hawkish, it's kind of the inverse situation. Usually you'll see treasuries go bullish, meaning the yields go bullish, not exactly TLT. Usually TLT runs inverse of the actual yields. But you'll see yields run bullish, you'll see the dollar run bullish, and generally you'll see equities lose a little weight. Um, Seeing how it's still a negative data set, it's still within the major dovish territory. However, it is showing an increase, or at least the forecast amount is showing an increase, which can be read as hawkish. It's hard to say if this is going to move the market or not, but technically this is the only data set we have in the morning, unless there's some speech or something I'm not aware of. So overall, that should be bullish for equities, but we will see. Now we have the 20-year bond auction at 1 p.m. We are expecting yields to still be increasing, which that's not a good thing. The long end of the curve, we don't want to be seeing at the 5.1% that it's at right now. But treasuries overall have been pulling up in yield. which again generally means that we should expect the 20-year bond auction to come in at a higher yield, which if it does, then generally that's going to be bearish for equities, because that's bullish for yields. Sorry, I'm losing my train of thought. There's a lot going on right now. Also preparing for a class and everything else. So overall tomorrow, not a super important day, but we do have a few reports that can shake things up a little bit. 20-year bond auction, again, we're expecting yields to go up, uh, but again, this can definitely move the market because this is the long end of the curve, and because it's the long end of the curve, any any movement can be very, very major, both for the treasury market and the equity market. So just be aware of that. That's at 1 p.m. Okay, Tuesday, June 17th. We have the core retail sales, uh, export import prices, retail control, retail sales, all at 8:30 in the pre-market. Now, these are very, very key data sets, and the reason why is because the export import price is how you find the sum of the GDP. That's a major factor of how you get that. Okay, so the funds that care, they read these reports, put those numbers together, and then they can get a reading on, oh, is the GDP going to be increasing or decreasing based off of that. So that's very important. Um, we'll go over that at a different time of how to actually read that. But um, they are expecting those both to come in pretty dovish. Uh, so that's a little concerning, actually. That could be bearish for equities, even though the data sets are dovish, just because that's pretty bad. That's pretty wow. That's actually really concerning. Um, that's really recessionary. That's showing a major pullback in GDP. So I don't like that, but we'll see how that turns up. Now, the core retail sales, they're expecting a slight increase. Um, Generally, that would be hawkish, but since we are trying to determine if the market is, um, or if the economy has consumers picking up weight still or not for the summer, so seeing an increase in the retail sales can be kind of bullish for the market in that way. Excuse me. Retail control, I'm not too concerned about that right now. They're expecting a probably negative rating on that. Retail sales, again, that's a very dovish reading. Um, that's showing major weakness. Okay. Sorry, I'm reading this in real time with you guys, so guys and gals see me. I mean, sorry, I'm very, very tired. Egg on my face. Anyway, 9:15 a.m. we have industrial production. 10 a.m. we have the business inventories, retail inventories. Not too concerned about the production right now because we all kind of know that production is very weak. Just kind of across the board, we've been seeing that. So, not really anticipating any sort of major uptick, but if we do, then obviously that can be used to move the market. Business inventories and retail inventories, um, for the most part, businesses have been so far holding it pretty fine with keeping their inventory in check with the tariffs. They haven't been needing to keep too low of an inventory or too high of an inventory. So not really expecting a whole lot from that. The tips auctions, really not important. That's just kind of a hedge to the actual auction or to the actual treasuries themselves. The Atlanta Fed GDP, that is kind of important because the last three readings have been very conflicting. And the reason why is because the last reading, as you can see right here, is a 3.8%, but the two readings prior to that, we're all the way up to a 4.6%, which um, was one of the highest readings you can get, um, in history. So that was very, very concerning. So we are seeing that pulling down. Um, that could have just been some crazy bump in some data set that they're seeing. I don't know, but again, that is somewhat concerning to me. Now, oil stock, I don't watch this at all, but again, if you're going to be trading oil, that might be something you want to look into. Wednesday, let's see, building permits, housing data, jobless claims. They have jobless claims. Okay, Thursday is Juneteenth, so not a trading day. Okay, cool, cool. So Wednesday's going to be an important day then because all of Thursday's data will be on Wednesday. Uh, any of the really important data anyway. So, let's see. We have continued jobless claims, building permits, housing starts, initial jobless claims. Okay, so the standard Thursday data, 8:30 in the morning. Um, Again, there's really nothing in here that's showing some major increase or decrease, kind of just across the board. Now, the continuing jobless claims has been on an upward trend. So that's slowly picking up towards that 2 million mark, which that is kind of concerning. We usually don't want to see that happening from an economic standpoint. Let's see. Initial jobless claims. Oh wow, the jobless claims have been picking up pretty much or quite a bit too, because generally we expect around a 184-ish, 190-ish mark just across the board. If you're going off of just the average. Um, Usually when I start seeing it pick up to 220, 240, 260, I start becoming very concerned because that's uh, hawkish reading. That's a higher reading. That's not good for the economy. Um, and I mean dovish. I apologize. Jobless claims going up is showing that there's more people on not unemployment, but on I can't think of it right now. I'm sorry, I'm having a brain fart. But you know what I mean. Um, So when that starts picking up, that's showing weakness in the market or in the economy generally. Now, let's see. Oil inventories. I don't really care about that, so I'm not going to pay attention to that. Atlanta Fed GDP now. Um, this can be kind of important, but I think that uh, generally this is going to be mostly ignored because we do have the interest rates um, being decided at 2 p.m., along with the FOMC statement and economic projections and stuff like that. Now we do have Powell speaking at 2:30, which again, FOMC days kind of are played in three different parts. You have the beginning of the day, so any of the beginning data sets in the day. That's kind of one part. And then you have the initial statement and, any data released during that. That is usually played in the second half of the day. And you reposition before Powell because generally the press conference with Powell will, give a whole nother swing to the market, whether it's to the upside or downside. Now, let's see. I want to pull up the CME productions really quick. Hold on one moment. All right, so this is the CME website, and this is one of the most accurate ways you can actually determine the next rate projection, um, or the interest rate projection. And what they do is they analyze a ton of data, and they're very, very, very accurate on um, what the projected outcome is going to be. So as you can see right now, and sorry I can't shrink the screen right now. Um, but a pause is at 96.8% odds, with the cut being at 3.2%. So very, very low odds of us seeing a rate cut come in. This 96.8% very likely tomorrow and Tuesday are going to pick up closer to that 99%. It was hovering around that 99% for um, a large majority of last week, so it's very likely we do see that stay as a rate pause. Now, moving towards July, September, you start seeing that rate cut starting to be factored in a lot more. October, you see the rate cut starting to be factored in or December. So the market is anticipating another rate cut this year, but definitely not right now. It doesn't seem like they want to do it for July just yet, but they are starting to consider it. They're essentially 20% saying, okay, potentially we could start seeing that rate cut come in. So very likely closer to September or October. But for right now, very likely it's going to be a pause. And from all the data I've seen, I would also agree with that. Very likely going to be a pause. So, with that said, I don't know if the FOMC statement and the actual rate projections or anything are going to do a whole lot for the market unless there's some sort of different verbiage inside the FOMC statement that these big funds pick up on. But I'm not really anticipating anything too important from the statement. Generally, I expect something important from the actual press conference, because they usually send pretty good reporters to ask good questions, and generally that can uh, get Powell to not exactly spill the beans on what the Fed is doing, but can give some very significant insight to what the Fed will do. So, um, for me personally, I always wait for the press conference. That's the big deal for me. Um, yeah, we'll discuss that more Tuesday night, but yeah, that's Wednesday. Thursday, again, it's going to be a holiday, so the market will be closed. We do have some minor data sets, but I don't care about those. Let's see. On Friday, June 20th, we have the Philadelphia Fed Manufacturing Index, Philadelphia Fed Employment. Not too worried about those. And that's pretty much it for the data sets. So, big data day really is going to be that Wednesday. Um, but potentially we can see that 20-year auction do a lot for the market, and we can see on Tuesday some of this retail data and some of this import and export data start to really um, take shape on the market as well. And, obviously that Wednesday is going to be super, super important. So, with that said, let's go ahead and hop into the earnings. And as you can see, um, there's literally nothing this week. So, there's nothing to talk about. Um, really nothing important there. So, let's go ahead and jump into the technical analysis. Just a quick reminder before we get into the technical analysis. If you've been finding value in my insights, consider joining my Patreon. For just $12.99 a month, you'll get access to my trades, courses, and powerful tools to help you grow as a trader. I'd love to have you be a part of our team and community. And it's less than 43 cents a day. So if you'd like to join, click in the link in the description. Thanks. All right, and getting into this week's TA, we're in kind of a tricky spot right now, but I'm going to help make it not so tricky. So let's go over the daily chart as always. Sorry, my mouth is getting all saliva. Bleh, gross. Anyway, um, Market closed exactly at 597 on Friday, and the overnight right now is at currently 597.86, so it's just slightly up, not very much at all. Um, the 5 mo is at 697, so with the market price closing at 597 exactly, we will see the 5 mo continuing to trend downward towards that 10 mo level. Now, potentially, we could see the 5 mo right up upon the 10 mo, which the 10 mo is at 598.18. And because the 10 mo is a longer term trend indicator, it's very likely we actually see the 10 mo pull upward slightly, one or two more sessions, even if we start selling off. So it's very likely we will see the 5 mo being very close to that 598, probably 598.80 range, give or take. It really depends on what price the market opens at, depending if we have some major selling in the open or some major buying in the open, obviously. But very likely tomorrow is going to be a day where we see the 5 mo challenging the 10 mo. Now, the 20 mo is at the 593.35. So again, it's starting to pull up towards that 595 range, which that's some major support. And that puts the market not very far away from, uh, performing a real 20 mo test, which we haven't seen, technically, I believe, since it was 425, if I remember. Yeah, 425 was the last time we had a true 20 mo test. So generally the 20 mo is tested once every month, month and a half. So if we like to think about moving averages kind of as clocks, then this clock is really starting to, um, you know, it's time for the 20 mo test to occur. Now, with the 20 mo pulling upward, it's currently at 593.35. It's very likely going to be opening very close to the 594 range, if not at the 594 range, which means that the upper bounds of the 20 mo is going to be pretty much right at that 596 area. Well, again, the market is currently at 597.86, so we're only $2 away from the upper bounds of the 20 mo. And if we get into the upper bounds of the 20 mo, that means that we can test the upper bounds, test the 20 mo level itself, and then test the lower bounds, which that pulls it down very close to that 592 range. Um, Now, the lower Bollinger is at 579.95. Sorry, I'm losing my voice. Um, which means that basically it's going to be right at that like 580 range. Um, it's still pretty far away. It would require essentially a whole $14 worth of selling without any support testing to get to that range. So, am I really looking for the bottom Bollinger right now? I thought I was, but at this point, no, I'm not. I think that we will start seeing some buying picking up pretty soon here before that. So just be aware of that. Um, sorry, my body's been really stressed out, which has just been making it impossible to breathe lately. Um, so the 5 mo or the 20 mo, we went over the upper bounds, lower bounds. The 5 mo, let's go over the lower bounds of the 5 mo. So since the 5 mo is going to be pulling down towards that 590, 880 range, give or take, um, technically the upper range of that 596 already puts the market within testing the lower bounds of the 5 mo. So with the market closing at the 597, and with the market price being at 597.89, technically we're 5 mo testing still. Um, and if this is going to be a rejection, and think again, think of the 5 mile kind of as a magnet. Either it's going to repel the market towards it or it's going to push the market away from it. If the market continues to repel the 5 mile, then it will essentially be pushed into testing the 20 mile. Um, and again, if we do get that 20 mile test, definitely set up the upper bounds of it, set up the 20 mile itself, and set up the lower bounds. And how to do that very, very quickly. When you're in the upper bounds of a moving average, and I'm not going to talk about duration too much, but just using the 20 mile as an example. If you're in the upper bounds of the 20 mile, you want to get long-term puts versus short-term calls. So if you're going to be buying puts, generally you want to buy for about 2 months out to cover the entire 20 mile move. Sorry, I'm having just not a great night. Um, and generally you want calls that are about half the duration of the puts. So in this circumstance, if you're grabbing the puts for 2 months, you want to grab the call for a month. And that call is the hedge to the put. That's the hedge if the market only tests the upper bounds of the 20 mile, then and bounces upward, then you're covered. Now, when you get to the actual 20 mile itself, you should be getting, a straddle for, generally about 2 months out. Um, Granted, I know not everybody can afford a full price straddle, but there's plenty of ETFs that track some of these major indexes that, um, have a lot of duration already built into it, where you can get a full in the money at the money straddle for about 500 bucks, for options, and that's exactly what you want. That's perfect. For the lower bounds, you do inverse of what the upper bounds is doing. So instead of a long-term put and a short-term call, you want a short-term put and a long-term call. And the reason why is if we continue pushing downward from the 20 mile and we do get that $14 sell down to the bottom Bollinger, then your short-term put is going to vastly outweigh the price of the long-term call, and it's going to cover that entire trade. But if you do get the bounce from that range, you have the long-term call for the entire upside exposure of retesting all the support again, retesting the 20 mile, retesting the 10 mile, retesting the 5 mile, heading back to the upper Bollinger, and again, um, we are overall bullish in the market right now. We are above the 200 mile. Our 50 mile is pulling upward. All of our supports for the short term have pulled above the 200 mile. So the market is in a bullish stance. So uh, if we do get to the 20 mile, which, I have full anticipation that we will, um, you should be setting it up to be prepared to go both ways because that's right between the upper Bollinger and the bottom Bollinger. And if you're paying attention, the 20 mile has the same value as the mid band of the Bollingers. So the 20 mile and the middle band are actually the exact same thing, um, which is, that's why it's saying that's the perfect range to set up for both sides. So just ensure you set that up when we test it this week. Very likely we're going to test it very early in the week, but again, we do have a lot of pretty massive data sets this week. So um, even if we set the entire week at that level, kind of just trade it the same. And I know smaller portfolios can't do that, um, but just take it as day by day. So if you can't continue buying straddles into this range, that's fine. Just take the single one or two contracts. Um, you don't have to keep tacking on contracts, and it doesn't matter if your contracts are a little red. in this area because this area isn't where the profit is. This is where you set up. Okay. Now, sorry, I'm running out of breath. Um, Talking about the 20 ma and seeing how if you've been following my trades, then that means that you essentially have puts from the very top of the 605 level, or within that 604 to 605 range. So that means you're very much in the money on a majority of your contracts, or very, very, very close. Okay. Um, what do you do with those contracts? I'm going to be taking profit at the 20 ma, and the reason why is because generally I would try to be a little more greedy for potentially that bottom Bollinger, but what I'm going to do in this circumstance is I'm going to absorb all the high IV from the move on the bottom Bollinger, and I will use that to slowly secure profit while setting up those new positions, and those new positions will cover my premium gain on, the bounce or rejection from this range. So I'm not too worried. Granted, yes, I know a lot of these contracts still have like a whole another week to 3 weeks out, depending on how far you bought out. Mine, I believe, are all the way until like July 20 something. So, I'm gonna be cutting these pretty early on, and that's totally okay. Um, a lot of these contracts are already going to be double in price, if not almost triple in price. So just take the profit, set up the move, and we will go from there. Now, I will be posting an options list for people in the alien chat in my Discord. Again, that's $12.99 a month. Um, I discuss market posturing and all sorts of cool stuff in there. Feel free to ask any of the members in there if it's worth their money. But a lot of the room is closing on some of those classes and stuff. So if you are interested in a little more help with your trading, definitely I suggest check that out. Talk to people who are already going through the program, and feel free to connect with people and ask them if they feel it's worth it or not. I work very hard to produce the content that I do, so um, I'm really wanting to eventually turn this into an accredited type of trading school. So yeah, hopefully I can continue providing everybody good technical analysis and content and everything. But anyway, enough sidetrack from there. Again, we are pulling away from that upper Bollinger. We're seeing the moving averages consolidate a little bit. Um, so again, the 5 ma is going to be pulling down, 10 ma slightly pulling up, the 20 ma pulling up. That means it's setting the market up for a very big bounce or breakdown. Okay, and that's why you set up that 20 ma range. Now, let's turn off the Bollingers, let's turn off the moving averages, and let's just quickly go over structure. And I want to, just one moment, I just want to go over drawings. Okay. Alright, so last week we started to see the this major selling channel start being breached. Now, that's a very, very bullish thing because this isn't a selling channel that's been breached in literally since it's began back in November something. So um this is a very major step for bulls. This is showing that yes, we are willing to uh you know break this bearish structure a little bit. Now, have we entirely broken away from this bearish structure? No. Technically, this can still be a very large inverse cup. Um, we have not gotten all the way up to that 611 range. And technically we only got up to that 605, so still a full $6 off the top range, which that may not seem like a lot in the grand scheme of things, but when making structures, it's a very, very large deal. So where do we kinda expect things to go? So we've been tracking this very large bullish cup, and I've been talking about it for months now, but it's very, very likely we do see some structure form in here to pull upward to hit that range. Now, again, I am bullish or I am slightly bearish right now. I do expect the 20 MA to be tested, and it's very likely that is. But very likely what happens from that is this turns into bullish liquidity. So the dealers will grab that 20 mile range for all those contracts, and then they will continue upward towards that 611 range. And that's a big reason why I want to really prepare that 20 mile range, because I do think that the market is really trying to set up for that all-time high again. Um, that would be the top of the cup, and from the top of the cup is generally when I expect the major bulls or the major bear structure to start forming. Um, and with that major bear structure, we'd see a lot more consolidation from the bottom Bollinger, which means that it would give this a lot more of an area to build a handle in, to head upwards to, potentially the 630, 640 range, within a few months. But for now, we should be expecting you know, that downside, and we are back within that major selling channel. So potentially we can go down to that bottom Bollinger, which is, why I'm saying you can be greedy. Just, really set the range up for it. Because there is the downside available. We just have to be prepared that this potentially could, turn around and head right back up to the all-time high range. So I will be taking profit at the 20 month for the short-term bearish contracts. I will then be positioning for, basically 2 months out, um, both long-term calls and puts and short-term calls and puts, and that in the money straddle when we get to the actual 20 mod itself. Now, structurally, again, we do see a large cup here. It's very likely we do hit the top of that cup, and from the top of that cup is when you expect to start seeing that bearish structure to pull downward to form that handle. And from that handle is generally when you start seeing that bullish structure to create um, the actual breakout from the handle. And very likely that's what's going to happen. And the reason why is because this is such a major support channel for the bears. It took a lot to break this channel. We potentially were starting to break it in this range. We did not have the liquidity, and we had to do a full test downward to, create the liquidity just to barely break over it. So very likely, again, we even if we pull upward towards that 611 range, it is extremely likely that we will see a major move down for enough liquidity to absolutely smash that channel. Now, let's go over something that happens this Friday, and that's going to be um, OPEX, which I always hate OPEX, but what's more important than OPEX is it will be the SPY dividend, which the SPY dividend is very likely going to be around 1.8. I'm having expectations of it being about 1.86, so that means it will take $1.86 right off the top, and the SPY price will open at that new price. So if we were essentially right at 600 and we had the SPY dividend hit, it would drop to that 698, 30, whatever it is for the dividend. Okay, so the dividend is reduced from the actual price of um, the equity itself. Okay, so that is coming this Friday. Uh, Very likely on the very bottom side, it's going to be 1.7, which that's the standard. But this has been one of the largest rallies of all time. So I do have a lot of expectations that's going to be pretty high, which means that Friday is going to be an extremely bearish day because of that. It's kind of a free short day. Um, and with the OPEX and everything, I think that's going to be a very red day. Potentially that's the type of day where we do get that $14 sell down to the um, bottom Bollinger. So uh, don't go crazy on short-term contracts trying to chase something like that, but just be aware of it. And we do have plenty of liquidity ranges that the market can grab downward. As you can see, we have plenty of liquidity right in this 580 range. Um, and that can be used to, again, kind of create this bear structure downward. So, um, yeah, let me see what else I wanted to cover. I don't want that. Structure. Let's see, short term, 1 hour. So on the hour time frame, um, we do have that larger, that major cup I've been talking about, but I'm not too concerned about that just yet. I am looking more at this inverse cup right here that it has formed. And you can kind of tell because we have support right in here, support right in here. It has formed a cup downward, and so far this has been, a major liquidity grab, and so far has been pushing back downward. So very likely this would create some form of structure, something like this. And generally I would have this being purple, but you all can see exactly what I'm seeing right there. That would test the 20 mile range again, and that would open up potentially that whole bottom Bollinger move if this is being used for some major bearish liquidity. However, we do have to keep in mind that this can potentially be used for bullish liquidity, which if it is, then we are going to be seeing, liquidity building in the two shoulders, and the head could potentially already be formed. So this can be a structure for a breakout of a larger cup right here to the 606 if the bulls want, short-term liquidity. And since we have that major selling channel right at the top there, a handle can be formed in that range to create liquidity for the breakout. So kind of a lot of different expectations to have moving into this week. Um, what I suggest, since the moving averages are so consolidated, is to really just focus on long-term duration stuff. Again, um, if we head back upward towards that 5 mile, then you buy contracts for the 5 mile, which means the long-term contracts are about 2 weeks out, short-term contract about a week out. If you're testing the 10 mile range, then you want the long-term contracts to be about a month out, with the short-term contracts being about 2 weeks out. If you're testing the 20 mile range, you want your contracts for the long range to be about 2 to 3 months out, generally two for the minimum, and the short-term contracts should be about a month out. Okay, and there's many different ETFs that can uh, mimic SPY movement. Same with, like QQQ. Uh, like, for example, there's TQQQ, there's SQQQ. Um, if you're trading semiconductors, like SOX, for example, there's SOXL and then there's SOXS. Um, there's SPACS-U and SPACS-S, that's inversely tracking the SPY. I make, quite a bit on SPACS-U all the time. I'm generally trading this every week, so you don't have to spend a lot on contracts to get that type of duration out. Just again, if you're expecting to set up the 20 mil and you can't set up both the upper and the lower range, then just set up one side of it or set up the middle of it. And you're going to be spending probably about $400 to $500 for the two contracts, but that's going to absorb the premium from the whole next move. If we head back upward like I think we do, then the upper Bollinger is going to be opening up and potentially we could be seeing, that whole 620 range. If we're going to be having some major blood, then the bottom Bollinger is going to be opening up and we're going to retest the 200 mont and there's a ton of room here. So just use it and make sure you set it up. I wouldn't just be trying to do short-term scalps into this. Generally, anytime I get a 20 mil move, I really do try to set it up with long-term contracts because that's the time to do so. Again, looking at the chart, if you set up long-term contracts in there at that 535 range, you would have had a whole $70 of upside. Um, you can't beat that. If you set up contracts back in the 566 range, then you had a whole $80 downside on that. So setting up the 20 mil is always a very good thing to do. But yeah, that's enough my spiel. That's my video. Yeah, take it level from level and go from there. Have a safe trading week. Just, again, be aware that Friday is going to be a pretty red day because of the SPY X dividend, which again, that's going to be hitting QQQ. That's going to be hitting everything. Um, that's going to be a pretty red day because of that. It's kind of a free short walking into that, so just be aware of that. If there is going to be some major selling red day this week, it's very likely going to be moving into that Friday. Um, yeah, I think I covered everything. Have a safe trading week, everyone. Have a good morning, have a good night, and I will talk to you in my video tomorrow. Take care.